Forget the noise you are hearing on the hourly chart. While everyone is looking at a green candle and getting excited, I'm looking at a full-blown liquidity trap right above us, and I need you to listen closely. There is one danger zone and one hidden opportunity in the pound today, and I'll show you both. We have a shocking UK jobs number that just dropped, ripping the floor out of sterling sentiment, yet the algorithm is forcing price higher. Stay until the end, because I'm giving out 3 exact entry and exit levels you can execute right now, including the specific invalidation point at 1.3488 that defines the entire macro trade. Here is your instant market verdict for the pound sterling to US dollar session. The daily bias is a continuation sell, but the intraday price structure is a corrective trap. We are fading this strength. The primary direction is down, aligned with the daily strong sell signal, but the 1-hour strong buy pressure is purely technical noise, a mean reversion into a broken zone of resistance. We are operating in a fading environment, not a trend-following one on the lower time frames. Write this number down, 1.3488. This is the invalidation level. If we close above 1.3488 on the 4-hour candle, the entire bearish structure fractures. If we stay below it, the short remains the only high probability trade. Do not ignore that number. It is the line in the sand between a dead cat bounce and a true reversal that let's strip the emotion out and look at the pure technical anatomy of this chart, starting from the top. On the weekly time frame, we are neutral, but look closely. The weekly candle is coiling right beneath the massive MA50 at 1.3427 and the MA100 at 1.3477. This is a massive convergence zone acting like a brick wall. The weekly neutrality is a pause for breath in a broader macro downtrend. We are not in a base building phase yet. This is distribution before the next markdown. Now, drop down to the daily chart. This is where the terror becomes quantifiable. We are staring down a strong sell signal. The price is currently trading at 1.3409, but look at the moving average configuration. We are trapped below the MA20 at 1.3506 and the MA10 at 1.3474. This is a dynamic resistance blanket that is pressing down on price. The death cross alignment is clear. Short-term averages are sloping below long-term ones, and the 200-day average is sitting right here at 1.3424, acting as a pivot magnet. The MACD on the daily is negative at minus 0.001, and while it isn't deep in the red, it signals a lack of bullish momentum. Sellers are just resting, not capitulating. The RSI is at 45.4. This is the most dangerous zone. It's not oversold. It has plenty of room to fall before finding a bottom. This is where bearish momentum accelerates, slicing down to the 4-hour chart. The trend is neutral, but this neutrality is a bear flag. We bounced off the critical structural support at 1.3339. That is the floor. If 1.3339 breaks, it's a liquidation cascade down to 1.3246. The next key support zone. The 4-hour chart shows price trying to push back into that daily MA200 resistance cluster around 1.3424. Buyers are currently fighting a multi-time frame gravity well. Here's what most traders miss. The volume on this bounce is declining. This isn't accumulation. It's a short squeeze on low participation, which is the perfect recipe for a bull trap. Finally, the 60-minute chart is screaming strong buy, and this is exactly where retail gets sucked in. The hourlies are painting a pretty picture of higher lows, but look at the MACD on the 1 hour. Is it truly powering higher, or is it simply retracing from an oversold state? It's a retracement. The 1 hour strength is just a magnetic pull toward the value area at the MA200 on the hourly. When you see a strong buy on the 60-minute inside a strong sell on the daily, you are looking at a counter-trend trap. You fade the 60-minute strength. You do not chase it. Let's bridge the technicals to the fundamental shockwave. Yesterday's UK job data changed everything. We saw a sharp deterioration in the labour market, and this is critical because it undercuts the Bank of England's hawkishness. Political risk in Westminster is denting sentiment, but it's the yield differential that is killing sterling. The British pound is not just weak on its own, It is collapsing against the dollar because the dollar killer narrative is fracturing. Right now, euro to US dollar and pound sterling to US dollar are the dollar antagonists, but only one is losing the battle decisively. While the ECB tries to talk tough, the bow is being backed into a corner by weakening economic data. The policy divergence is widening, not in sterling's favor. Bond spreads are blowing out, and the US dollar index is finding a bid, which acts as a headwind on this pair. This brings us to the cross-asset narrative. We are seeing the dollar strength flow through the entire risk spectrum. The DXY is stabilizing, and that puts a direct cap on cable rallies. If you look at euro to pound sterling, it's holding firm, confirming that the weakness is pound-specific, not just dollar strength. For the 1 to 2 week directional lean, we remain aggressively bearish on pound sterling to US dollar. The invalidation thesis is simple. A daily close above 1.3544, the upper structural resistance. If that happens, the political risk discount evaporates, and we could see a short squeeze toward 1.3600. But until then, the path of least resistance is down toward that 1.3246 target. Most people will skip this section to look at the comments, but this is where money is made. Keep watching. We have a trap to exploit. Let's get surgical with 3 specific battle plans. This is the patient trade, waiting for confirmation that the bear flag on the 4-hour has resolved. We are not entering yet. We are waiting for the trap to spring shut. The exact trigger condition is a breakdown and a 4-hour candle close below the critical support level of 1.3370. This confirms that the liquidity grab above 1.3400 is over and they, sellers, are back in control. Only then do you enter short. Your stop loss goes at 1.3440, just above the daily MA200 resistance. The logic is simple. If price recaptures the 1.3424 area, the breakdown failed. Your target one is the swing low at 1.3339, giving you a solid 1 to 2 risk-reward ratio. If we slice through 1.3339 with volume, target 2 sits at 1.3246. That is the weekly support that aligns with a deeper liquidity pool. This setup is voided if we get a bullish MACD crossover on the daily chart. For those who want to capitalize on the current exhaustion without waiting for the breakdown, this is the fade. The active entry condition is a pullback right into the moving average brick wall. You are looking to sell a limit order between 1.3465 and 1.3480. This is the convergence of the daily MA10 and the descending trend line. You are fading the last gasp of the 1-hour strong buy momentum. Your stop-loss placement goes at 1.3510, strictly above the daily MA20. If price gets above the MA20, the sentiment shifts from a sell to a neutral range, and you must exit. Target 1 is the value area low at 1.3385. Take partial profits there. Once target 1 is hit, move your stop-loss to break-even. Target 2 is 1.3340. The risk-reward here is superb. You are risking 45 pips to make nearly 120. This is the institutional fade play. Let's see how aligned we are with the macro sentiment. Type your pound sterling to US dollar range for tomorrow in the comments right now. Do you see us testing 1.3339, or do you think we chop sideways? I'm reading the comments during the London close. Strategy 3, the aggressor, high risk. This is the bull trap hunter. The aggressor strategy relies on entering immediately on a false breakout above 1.3440 on a 15-minute candle. You wait for the wick to poke above 1.3440, reject violently, and close back below 1.3420 on the 15-minute close. That is your trigger to smash the sell button. This is a momentum chase based purely on the trap psychology. The stop loss is brutally tight, 1.3455. You are betting that any break above the 200-day is a deviation. Invalidation is quick. If the 15-minute candle closes above 1.3455, you are wrong and you get out. Your target 1 is a quick scalp at 1.3380. Target 2 is 1.3350. This is high risk because you are fighting the intraday momentum, trying to catch a falling knife. Only for those who know how to lose small and manage risk aggressively. Do not widen your stop on this one. A quick pulse check on risk. Never risk more than 1 to 2% per trade on a pair this volatile with UK headlines dropping randomly. No positions through high-impact UK CPI or Bow speeches. Stops are non-negotiable in these thin liquidity traps. Protect your capital first. Let's synthesize this down to the one thing that matters. The most critical level for the next session is 1.3339. That is the structural floor. If it breaks, the trap is confirmed, and the sellers are in full control down to 1.32. If it holds, the chop continues. Tomorrow, my focus is laser-locked on the Bow rhetoric. Any dovish hint regarding the jobs data will be the catalyst for that break. We are sitting on a powder keg. If you want the full breakdown on the dollar index and how the S&P 500 liquidity tide is dragging Bitcoin into a risk asset trap, that video is live now. Check the end screen. The divergence in equity flows is shocking today. Smash the like button if this analysis gave you a clear, executable plan for the session. Subscribe and hit the bell for daily institutional coverage of all 8 assets. I'll see you in the next one.